This is the gentleman from Florida, Mr. Ross, for 5 minutes.
Thank you, Chairman, and thank you, Chair Yellen, not only for being here, but also for your endurance and agreeing to be here to take questions from all of us. I don't envy your job because it's quite a balance. I mean, your monetary policy has to make sure that we not only allow for enough liquidity in the markets at an affordable rate, but we also have to make sure that there are those who are reliant upon investment income, seniors predominantly, whose savings accounts can survive in this environment. And when your predecessor was here before, Chairman Bernanke, he talked about the effect on the seniors who have fixed incomes and aren't concerned about home appreciation. They're more concerned about CD rates, savings accounts, because that's their livelihood, that's their income. Can you comment at all as to any hope or suggestion for those seniors of mine back home that are on a fixed income, that are dependent upon not a zero interest rate, but at least some return on their investment as being able to allow them to live an affordable life?
So I know that this is a difficult situation for seniors in that position, and I would simply say that our objective is to get the economy moving and into a state of full recovery as rapidly as we can. And when we have accomplished that, rates of return will come back to more normal levels.
Do you feel
and
that
you'll see higher returns?
The reduction in the asset buying, do you think that may have a positive impact on some of these fixed income accounts?
Well, I would say the reduction in our asset purchases in part importantly reflect a stronger economy. We see an economy that's now meaningfully recovering, the labor market improving, and as that process plays itself out, I think seniors can look forward to higher interest rates. It's our objective.
Let me quote you something. There's a commentary that was in the Wall Street Journal just recently by Mr. E.S. Browning, an investment advisor, and he states that if you don't invest in U.S. stocks, the thinking goes, where else are you going to invest? Developing country markets have turned unstable. Europe is struggling. Cash and high-grade bonds offer the tiniest of yields. Many experts consider junk bonds overpriced. Hedge funds are struggling. The Fed is determined to get people investing again by keeping rates down and forcing them to take risks. Anyone who refuses to buy stocks, in other words, is fighting the Fed. So I guess my question is, it seems that the Fed policy is not only affecting my seniors, but all investors. And I guess, should we be concerned about families trying to save for college education because now they're going to be risking or investing in more risky options? Is that what we see to come?
Well, interest rates are low, and they're low not just because the Fed arbitrarily decided to set them at a low rate, but because the fundamentals of the economy are generating low interest rates. That normally we think of interest rates as reflecting a balance between savings and investment, the strength of those forces in the economy. And in the aftermath of the downturn, the desire to borrow money for private investment is weak, and a reflection of that is low rates. If we were to try to keep interest rates above the levels called for by fundamentals, we would have a yet weaker economy. It would be harder to get a job, and the children and grandchildren of those retirees would be coming home even more than they already are to live with their parents and grandparents, because they would find it even more difficult to get jobs.
But haven't we already limited the investment opportunities? I mean, has not Fed policy already limited investment opportunities for many out there, other than leaving for high-risk investments?
In an environment of low interest rates, there is an incentive to move to higher yielding investments, and it is important for the recovery of the economy that people be willing to take some moderate risks.
Let me ask you real quickly about the SIFIs, because you've talked about this in your opening and on other questions. There seems to be confusion regarding the process involved and what constitutes or designates a SIFI, but there must be some methodology involved. So if a firm is, hypothetically speaking, designated a SIFI, is there some action that they can take to be removed of that designation?
They have, absolutely. It's an important for them, and they have the opportunity to have very serious consideration before the FSOC and to protest the status and have it reconsidered.
Time of the gentleman has expired.